Alright, welcome back to the channel. It's no surprise to anyone that 2022 has been very difficult for investing. We've all seen our investments lower in value and become worth less day after day and week after week. So one way we can create income is by selling covered calls, and right now is a great time to be deploying this strategy. So if you don't know what that is, it's when you sell calls against your existing long position. The key to that though is that you have to either have 100 shares of the underlying stock, doesn't matter what stock it is, or B, it would be that you would have to have a long leaps position, that called a poor man's covered call. So this strategy is useful when either the market is trending sideways or trending downwards. However, you don't want it to necessarily go up against your call, because if that's the case, you essentially cap the amount of money that you can make. However, if things are trading sideways or downward, you get to keep the premium, and I mean, it's better than getting nothing and seeing your investments go down in either way. So the idea behind covered calls is that if things do start trending upward, it does limit your upside, so that is something you do have to take into consideration. However, if things are going sideways or down, you either A, collect the entire premium, or B, you get to either roll it over depending on how you want to deploy the strategy. So the way that I've been deploying the strategy for the bulk of 2022, so let's say stock A is currently at $100, and I'm going to sell the $110 strike price that expires in either a week, 2 weeks, or 4 weeks. I mean, personally, I like to do it week by week and be more active, but again, it just depends on how you want to deploy it yourself. So $110, and currently it's at $100. Let's say one day the stock price goes up to 105. I'm going to collect more premium when the stock price is currently at 105, more than I would than if it was at $100. The reason for that is because there's more likelihood that that stock is going to hit 110 by the expiration date. And especially given the fact that we're in a bear market rallies are going to be prevalent. They're going to be trapping investors into that FOMO. So it's a way that we can take advantage, especially when we use technical analysis to our side, looking at those key areas of where sellers are likely to step up and push the price back down. And to add another layer of confidence, in addition to my technical analysis, I'll take a look at the stock on Yahoo Finance, specifically the option chain and open interest. Whichever strike has, or whichever couple of strikes have the highest open interest, likely Wall Street isn't going to want those to finish in the money, as usually it's Wall Street that's selling those options to retail, and they're not going to want to pay them out, obviously. So what they'll do is they'll manipulate the price to keep them under that strike price, at least until the expiration. So again, using stock A as an example, let's say the 110 strike price has the highest open interest. What sometimes you'll see is by Friday on expiration, you'll see that it closes at like 109.99 or 109.50 or something, just expiring them just out of the money so they can collect the full premium, and then they get their lobster dinners on Friday night. Cool, so we'll take a look at a few examples, we'll look at some technical analysis, and then combine them with the Yahoo Finance option chains. So again, guys, if you haven't already, subscribe, like the video, and check out my links below for links to my Instagram, my Twitter, and my TikTok. So let's first start off with the SPY as our first example. It's the index of the S&P 500. It's one of the highest volume ETFs. A lot of people trade it. So we're currently at $380 per share. We had a rough sell-off today, actually down about 2%. Just coming off at 20 EMA at around $390 per share. So let's use 390, 392 as our key area of where there's going to be a lot of supply. So when we take a look at Yahoo Finance, we click on options. It takes us to the option chain. Let's change this date to the expiry of July 1st, which is this upcoming Friday. And then we scroll down to open interest. We click on that and sort it by the highest amount. And what we can see is that 31,747 people have an open position of a strike price of 400. Again, this is subject to change day by day, hour by hour, depending on the price action, because as it currently stands, that's the current amount. And what we notice is that each one is currently worth about $16 per contract, losing about 82% just over one day. Options are very, very volatile, and you have to be very nimble and quick getting in and out to be profitable. But we really notice the first two at 31,000 and 25,000 being much more than 15 and 13, and then again it tails off even more. So we notice the 400, the 390, the 395, and the 405 have a much higher open interest than the 420 and so on. And they're very closely knit, so it doesn't give me that much confidence because they're so close to one another. But assuming that I'm comfortable at 400 or 390 or 395 to cap my gains by the end of the week, then I mean, it doesn't really matter what it does if I'm comfortable selling it at that price by July 1st. All right, taking a look at QQQ, ETF for the NASDAQ. Again, today was a pretty brutal sell-off. Let's say we have a key area or key supply zone of about 295. If we take a look at Yahoo Finance, the option chain, let's change the expiration to July 1st. We see that the $300 strike price by far has the highest open interest by almost double the amount of the next highest one. The issue with this is that because of today being such a big sell-off, we see that it lost 95% of its value ever since the day before. So really it wouldn't be worth it to sell a $3 contract or even a $7 contract at the 295 strike price, because at that point it's just unnecessary risk, and then you're capping your gains in case there's a big rip rally into the end of the week. And if you were to have sold a $295 strike the day before, it lost $208 of value, 96% in just one day. Again, options very volatile. You can lose value just like that or gain value just like that. To give you guys an example of how volatile things are, and it's happened to me more than once, but last week specifically, I had sold the call and the next day was a rip rally, right? Ever since, again, today, I lost a lot of value, but last week it had gone up, and I think I was down on my position maybe 400%. In just one day, I was down 400% on the original amount that I had sold it for, but right now I'm up 50%, just to show that how quickly things can change and how really brutally volatile things are. A very high volatile stock, we have AMD. We have a clear level of supply at about 88, let's say $90. If we take a look at the option chain, July 1st, open interest. The highest level, again, by far, almost double the second amount, is at $90 strike price. Today losing 87%, a change of $68 per contract. So this, for example, if I had 100 shares of AMD or if I had a Leaps contract, and I saw this open interest and it was still worth more than $10 per contract, would have given me a lot more confidence than looking at the SPY. As a SPY, the open interest was so close to one another, whereas here it's almost double the next highest one. In addition to that, we also saw a clear level of supply on technical analysis. However, if you were to sell that before the sell-off, you would be selling it close to at the money, and is that a risk you want to take? So these are all things you have to take into consideration, if it's how close it is to the money, and again, the levels of supply and the open interest. And lastly, we'll also take a look at NEO. So this one has actually done very well over the last little while, and again, that would make me a little bit more confident, because the higher the price goes, it would need a little bit of a breather and pull back, especially as it's entering a level of supply at around $23, which is in fact what happened over the past couple of days. So 23, 24 would be an area of supply. If we take a look at Yahoo Finance, July 1st, we look at open interest. The highest level by about 4,000 contracts is about 25. And today, as the stock was down 2.5%, that option lost 66.67% of its value, about $18, which isn't that much. But again, it's some way to make a little bit of income. But the reason why it's not that much is because NEO is only worth $22, and the higher the stock price is, the more money you're going to be playing with, obviously. Alright, so that's the end of the video. When it comes to options, selling, buying them, whatever, it takes a lot of experience. It does sometimes take a lot of heartbreak. It can be really nerve-wracking to see your position is down over 100, 200, 300, whatever percent in 1 or 2 days, or whatever's happening in the markets, especially in times like this when things are volatile. However, if you don't have to do it like with an expiration that expires the same week like I do. You can do it 2 weeks, you can do it a month out, or you can even turn it into a spread if you do it longer term. It just really depends on how you want to implement the strategy and whatever works for you. Otherwise, guys, that's the end of it. Thank you very much for watching. Don't forget to subscribe, like, check out the links below in my description, and I'll see you guys in the next video.